Russ, let's start with HSBC, one of the biggest gainers today on the FTSE 100. So headline profits down, underlying profits up. Market like what they heard?
I think it did, mainly because the fourth quarter numbers had been such an absolute mess that it was actually a relief to get a relatively straightforward set of figures. And if you looked, retail banking, investment banking and commercial banking all showed year-on-year improvement in operating profit. And I think that was what the market really latched onto. The tricky bit is there were still some one-off items in there that did make the numbers difficult to interpret. Another couple of £100 million worth of PPI provisions, for example. So they're not out of the woods there yet. But nevertheless, the numbers do look to be getting a little bit cleaner, a little bit more straightforward, and there was some underlying growth there, which I guess was the major relief.
Yeah, Asia seems to have come back quite nicely for them.
I think that's the big thing. Obviously, the numbers were a little bit distorted by the sale of the Brazilian operation, so they've washed their hands of that one. The bank overall is still shrinking its way back to health. Assets are still falling, and loans and deposits are still slightly down year on year. So long run, I think in the short term, you've got cost is a big story, Asia is a big story. Long run, it's where's the real growth coming from, given that it's been spending so much time shrinking itself, and it's still got the regulator on its back as well.
It's a big year for this bank because, of course, they've got a new chairman coming in Mark Tucker. We expect Stuart Gulliver, the CEO,
to be on his travels next year.
Yes, but we still haven't had confirmation of that from the bank, have we?
No, not at all. Mr. Gulliver's dropped some very heavy hints that 5, 6, 7 years is quite enough, thank you very much, but there's been no confirmation yet. I think they wanted to get the chairman in place first, and then Mr. Tucker can clearly put in place a very clear succession plan.
Now, in terms of the horror shows that we saw today, Next was probably the biggest one. Last month they announced their first drop in profit since 2009, and today profits warning. Yeah,
again, Lord Wolfson sort of refined their profit guidance for the year. Sales now expected to drop 1.5% rather than 0.5%. He shaved about 3 to 5% off their profits forecast. It just looks to be a very, very tough market out there. And don't forget, Next is one of these companies that's actually trying to increase prices, which in a fast fashion market that's very price conscious really isn't terribly easy to do. And I think that's one of the things that's probably causing them some pain at the moment.
What was really shocking about this, though, Russ, wasn't it, was the fact that shop sales were down 8%. So online is washing its face. People just not going in the stores.
It's the gold clicks versus bricks story that we've heard so much in the retail environment overall. We saw fantastic numbers from Boohoo and ASOS recently. It's clearly taking its toll on the high street. Next does have a very strong online presence, but I'm not sure its website's quite as slick as some of the competitors out there, and that is definitely causing the company some trouble. And in fact, analysts are now expecting profits to drop they did drop last year, now this year, and indeed the year after as well now.
So no easy fixes for Next? Then?
Not at the moment. Obviously, it would be wonderful if the economy was to start firing on all cylinders, but consumer debt, including mortgages, is already at a record high, so it's hard to see how much room for manoeuvre is there. The one thing that probably would make their life easier is if the pound starts going up. Now, they may not be holding their breath, but that would certainly help them in terms of raw material costs. It would help consumers in terms of less inflation, and it means the company wouldn't maybe have to start popping prices up by 4 or 5%, which perhaps they're finding quite difficult at the moment.
Now, another of the big boys of the market, Royal Dutch Shell. Again, market really liked what they heard today. Clearly, they've been boosted by the lift up in oil prices, but the BG acquisition last year looks to be paying off for them.
Yeah, there was a lot of doubts at the time, and I must admit I was a little bit sceptical myself, so I'm eating a few words. The oil price up 55% year in a year on average in the first quarter is a massive plus for them. The exploration and production business went back into profit, refining made a higher profit, but the company is helping itself. Production volumes were up 2 and costs were down 8, and I think that's a lot of the BG costs being ripped out, and that's where the company is working particularly hard. And best of all, I think, cash flow was very strong. It more than covered the dividend, which makes a nice change. And from an investor's point of view, that's the real core to the stock. I don't think anybody's expecting the underlying production growth to go through the ceiling. But if that 7% dividend yield is safe, a lot of income hunters will hug it to their chest very, very closely.
To their chest, yeah. It's worth remembering. £1 in every 8 worth of dividends received by UK pension funds comes from this company.
It's enormous. But we must remember as well, you mentioned already the oil price has been very volatile in the past few years. It started to go down again, which obviously isn't going to be helpful. And I think the finance director today said that $1 on oil is about $500 million on profits for the company. So it's still very, very sensitive to the price of crude.
Yeah, so barrel of Brent went below $50 a barrel today for the first time since November, I think. What was going on there?
I think there's some nerves ahead of the OPEC meeting in Vienna on the 25th. Will they stick to the production cuts that they pushed through last November? You've seen American inventory stockpiles of raw crude and refined gasoline have stubbornly refused to come down in Oklahoma, Cushing, Oklahoma, and are still at very high levels. And US rig activity, you can track it every week from Baker Hughes, has gone through the roof. It's more than doubled from its lows last year. So as soon as oil hits around $50, those shale drillers in the States fire up the rigs again and start pumping out crude. So you still do look to be looking at a bit of an oversupplied market ultimately.
Yeah, there you go. There's the price at the moment.
Oh, well, there we are.
48 a barrel, down 4.5%. Woof. And briefly, we had Morrison's as well. 6th consecutive quarter of like-for-like
Which the market
growth.
liked very much. I mean, a 3% increase from the retail business, I think 3.5% overall. Boss David Potts does look to be doing a very good job. I mean, he talks about some of their fresh product ranges going rather well. Women's wear, he actually flagged interesting, has been an area where they've been particularly aggressive. Marks and Spencer's next shareholders probably a little bit less enthused about that. It may be an additional complication for them. But again, expectations have been low for this company. It put through its first profit increase last year for 4 or 5 years in big contracts to Next. But equally now, the market is looking for profit increases this year and next year as well. So momentum does look to be building, more of a self-help story than an overall market story.
It is a challenge, though, now, isn't it? 'Cause it's growth on growth.
Yeah, that's the thing. And also, if you look at the Kantar World Panel numbers yesterday from the consultants, Morrison's, Tesco's, Sainsbury's still lost market share year over year to Aldi and Lidl and those discounters. It is still a very, very tough market. The company isn't going to be resting on its laurels, I suspect.
All right, Russ Mould, very comprehensive canter through the numbers there.
Pleasure.
Thanks for
Not
that.
at all.